Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. After the discussion of various types of costs classified into accounting costs, economic costs, direct, indirect, opportunity costs, explicit cost, implicit cost, sunk costs, incremental costs, historical cost, replacement cost, or private cost, social cost, fixed cost, variable cost, like this, various terminology related to the classification of costs has been discussed in the earlier sessions. Now let us continue with the real technical aspects of this chapter, that is chapter 3, unit 2 of business economics, that is the theory of cost, starting with cost function. Just like production function, cost function is also a mathematical relation. Naturally, in case of production function, the relation was between factors of production and quantity of production. Here, the relationship is between various determinants of costs, which is nothing but the costs of factors of production and cost of a product. So here we are not talking about the quantitative terms, we are talking about monetary terms. So, in a cost function, what is the dependent variable? That is unit cost or total cost of manufacturing a product or rendering a service. And what will be the independent variables on which this total cost is dependent? That could be the price of the factors or size of the output or any other relevant phenomena which has an impact on cost, like technology, capacity utilization, efficiency, or the time period under consideration. All these things will have impact on the cost. But majorly, the relationship between various determinants of cost and cost itself is what is called as cost function. And as we just now identified, this cost function is nothing separate. It is also an extension of production function only. But only point is, it expresses the relationship between the costs and output. So here, the cost functions are derived from the actual cost data, and these are presented generally in the form of cost curves or graphs, we can say. What will be the shape of the cost curves? That certainly depends upon the cost function itself. And just like in the case of production theory, here also there are two kinds of cost functions. One is a short run cost function and the other one is long run cost function. Both of them we will study one after the other. But before going to once again the cost function and the short run, long run relationship of different types of cost, let us understand the concepts related to the total costs, particularly in the short run. The total cost we are talking, always the words are important to be observed. We are talking about total cost, that too when in the short run. And the classification naturally will be once again the total cost, which can be further classified into fixed and variable costs. What are fixed costs? Those which will not change even though the level of activity changes. That means the level of output changes. Even though the level of output or level of activity changes, the fixed costs remain constant. Level of activity is a better word to use than level of output, because output means only a manufacturing organization will be covered. Service organizations we can call the same as activity. So whenever we use the word level of activity in future, just understand we are talking about how much output is being generated if it is manufacturing, or what is the scale of the operations, what level of operations are happening if it is a service entity. But again, for service entities, all these things will become more and more difficult to be applicable. So we stick to the manufacturing type of examples wherein we can observe how the total cost, fixed cost and variable cost will behave. Certain factors will be adjusted with the changes in the level of output. For example, number of workers, if it requires more, generally it can recruit more people. Generally people are available. Same way, if it wants more raw materials, it can purchase. It will be available. So those are generally what varied with a change in the level of activity. Those are called variable factors. On the other hand, certain factors like building, capital equipment, or the top management team cannot be easily varied. That means not that they can never be varied, but it requires comparatively a longer time to make changes in those factors. Like for example, to install new machinery, to purchase, it may take a lot of time. Or to build a new factory, it will take a lot of time. So these factors which cannot be readily varied and which require a longer period to adjust, those are called as fixed factors. So when you have variable factors which are adjustable along with the level of output, there are fixed factors which are also adjustable but not possible to be adjusted in the short run. They will take longer time to get adjusted. Those factors are called variable factors. When we say fixed factors and variable factors, accordingly, definitely there will be a distinction between short run and long run periods of time. And we already observed this. What is a short run? In this case, is that time in which the output can be increased or decreased by changing the amount of variable factors. We can change the output, increase or decrease according to increase or decrease in variable factors like labor, raw materials, etc. And in the short run, fixed factors cannot be varied. This also we already observed in the production function also. In the short run, at least one of the factors will be fixed, but practically many factors will be fixed. But at least one of the factors will be fixed in the short run. Same logic applies here also. Certain fixed factors like machinery, plant, equipment, buildings, etc. cannot be varied in the short run. So that is the definition of short run here. Very similar to the definition of short run in the production function also. So what can be changed in the short run? Only the variable factors can be changed but not fixed factors. If the firm wants to increase the output in the short run, it can only do so by increasing variable factors. That is the only option. It cannot change fixed factors. The fixed factors remain unaltered. That's what is short run. Then what is long run? Naturally, where all factors may be varied, because every factor can be changed in the long run. There will not be anything fixed factor in the long run. If you want machinery, it will take time, but in the long run, you will get it delivered, you can fix it, you can install it and start a new factory. All these things are possible in the long run. So there is no factor that is fixed in the long run. In other words, all factors become variable in the long run. Whereas in the short run, only variable factors can be changed in order to change the output. Whereas in the long run, all factors can be changed in order to have any change in the output. So there will be fixed factors and variable factors in the short run, whereas in the long run, all factors can be considered as variable only. There is nothing fixed in the long run. That is one understanding we can generally have when we look at the short run and long run classification, particularly looking at fixed and variable factors point of view. This can be applied to costs also, the same concept. Look at this graph in figure number 5, which is a completely fixed cost. Completely fixed cost means the cost will not change. So what is happening here? Even though the output is changing, the fixed cost is constant. There is no change in the fixed cost. So when it is constant, naturally there is no change in this. It is a straight line parallel to the x-axis. But what are there on x-axis, y-axis? That you should see. Output is on the x-axis. Though the output is increasing or decreasing, the total fixed cost remains, total is important. Total fixed cost remains constant, same. So it is parallel to x-axis. And once again, this is total fixed cost and completely fixed cost. Then figure number 6 tells us about completely variable cost. This is completely variable cost, and as the output increases, because variable cost in total will be in direct relation to the output. In other words, as the output increases, the variable cost also keeps on increasing. So that is why there is a direct relationship between output and total variable cost. Once again, the word total is important. Total. So as the output increases, the total variable cost also increases. And since there is a direct relation, naturally the slope of this curve is positive, which is going upwards from left to right. So the fixed cost remains constant irrespective of the level of output, whereas variable cost goes upwards as the output increases, because there is a direct relationship between output and total variable cost. Whether the relationship is proportionate or not, that is a different story. May or may not be proportionate. That will depend upon other factors. But is there a direct relationship between output and total variable cost? Definitely yes. As the output increases, the total variable cost increases. If the output decreases, the total variable cost also decreases. That is why we call it as direct relationship between output or level of activity and total variable cost. Right? That is the two things we have to observe. And another thing you can also have an observation about variable costs is, if the output is 0, variable cost is also 0. It starts from 0. If you are not producing anything, why would there be any variable cost? No variable cost will be there. But if you observe here, even if the output is 0, the total fixed cost is there. So irrespective of the level of output, fixed cost is definitely going to be incurred. It will not start from 0. It is somewhere. But in case of variable cost, total variable cost, it starts from 0, since when there is no output, no variable cost is required to be incurred. So that's what is the distinction between fixed cost and variable cost in a graphical form. And the same thing is explained here. What is a fixed cost and a variable cost? So what are the fixed costs? Which are independent of output. They have no relationship with output. They do not change with the changes in output. Those are fixed amounts which are incurred by the firm. Of course, whenever we say fixed, we have to understand we are talking about short run. Why? Because in the long run, there is no fixed, everything is variable. So the word fixed cost itself gives us, we are talking about short run. Irrespective of whether the output is small or large, these will be incurred by the firm at a fixed amounts. Even, for example, the firm closes down for some time in the short run, remains in the business, these fixed costs have to be borne by, same thing we have already discussed earlier. For example, the rent that is agreed to be paid to the landlord, or insurance that is supposed to be paid to the insurance companies on the assets that the company owns, if it has. Same way, maintenance costs, property taxes, interest on capital employed, or the manager's salaries, or anybody's salaries for that matter, the watchman's wages, etc. These are all fixed costs, examples of fixed costs, which have to be paid irrespective of there is production or not, because these are contractual in nature. These are committed costs and programmed fixed costs, as we discussed earlier. So that is the nature of fixed costs, which will remain constant irrespective of the level of activity or output, whereas the variable costs will vary in line with the level of activity, in the same direction as the level of activity, and that is related directly to the level of activity. Hence, variable cost starts from 0 and goes upwards from left to right as the level of activity increases. Level of activity is nothing but output. That is about fixed and variable costs. The same thing is mentioned here. For example, variable costs are those which change with the changes in output. Examples also we have seen. For example, the wages of the casual labor. Casual labor means they will work if we ask them, they will not come if we don't require them. We are not talking about contractual labor who are already there on the rolls and they will be paid whether there is work or not. No, if it is a case, that becomes fixed cost. Casual labor usually will be paid only if they work. And why they will work? If there is production, then only they will work. Same way, raw materials. fuel and power. These are the things which will be directly related to the level of activity. Even if a firm shuts down for a short period, it may not use the variable factors of production. So there will be not incurring any variable cost if at all a firm shuts down for a short period. See, shutting down is not an option. Normally it is only a imaginary situation. If the firm shuts down also, fixed costs will continue to be incurred. Whereas if the firm shuts down, the variable cost will not be incurred because there is no activity. When there is no activity, no production, why you have to pay wages to anybody? Why do you need raw materials? Why do you need to use fuel and power? Why do you need transportation, etc.? These are only applicable or incurred when there is production and some activity happening. If there is no production, no variable cost. That is complete variable cost, what we are discussing about, which was depicted in figure number 6, which will be directly related with the level of activity. So what can we conclude here? The variable costs will change linearly with the change in output. With that assumption, without any curves at all, straight line we have drawn, that's okay. But they will go along with the changes in output. Output increases, total variable cost also increases. Output decreases, the total variable cost also decreases. That is total fixed cost, total variable cost, completely fixed cost, completely variable cost. Now there can be other type of cost, popularly also called mixed cost. Mixed cost means there is a component of fixed portion also and there is a component of variable portion also in such type of costs. Certain types of costs can be called like semi-variable costs. These are semi-variable costs. So semi-variable costs these are. When can we call them semi-variable costs? Where they have a fixed component also and they have a variable component also. For example, the best example for total semi-variable cost is sales people's remuneration. So sales personnel, marketing people, salesmen you call them, how their remuneration will be fixed generally. There will be some fixed portion. Let us say some 10,000 rupees per month. Fixed portion of remuneration is there for them, irrespective of the level of activity, irrespective of the sales achieved by them. Plus some percentage of commission on whatever the sales that they would achieve. That will be generally given as remuneration to the salespeople. Which means what? There is a fixed component also, which is 10,000. There is a variable component also, which is the commission that they get as a percentage of sales achieved by them. That is an example of semi-variable cost. Of course, for the salesman, it might be income. Naturally, for the company which is paying this, it is a cost only, right? So the salary that is paid to the salesman can be considered as fixed component. So it is this much. That is standard fixed component. And the commission that is paid is this much. That is variable component. And that will depend upon the level of activity. Of course, here output or sales, whatever the level of activity may be. According to the level of activity, the variable component will also grow. If output or sales is increasing, variable component also will increase. If output or sales is decreasing, variable component also will decrease. So if the salesman achieves more sales, he will get more commission. He achieves less sales, he gets less commission. On the same other side of it, company pays more commission when sales are more. Company pays less commission when sales are less. That is a variable component. But the salesman's total amount of emoluments that he receives or the total cost that the company incurs by paying to the salesman include both fixed component also and variable component also. So that is what we call as semi-variable cost. Okay, that is the total semi-variable cost. But if you observe the difference between a normal variable cost curve and total semi-variable cost curve, in case of a normal total variable cost curve, the variable cost starts from 0 because nothing is fixed there. Entirely it was variable. But here, this semi-variable cost will not start from 0. It will start from here because this much of fixed cost has to be incurred irrespective of level of activity. So it starts from fixed cost. Over and above that, level of activity is more, variable component increases, naturally the total semi-variable cost also increases. That's how semi-variable cost will behave. There will be a fixed portion, but there will be a variable portion also. Another example you can take, if you observe your electricity bill of your home also, there will be both a fixed charge and a charge based on consumption. Some amount will be fixed charges, 100, 200 rupees, whatever it is fixed charges. That will not have any impact, or that will not be impacted by your consumption. Whether you are in the house or not, whether you used or not, did not use, you have to pay that. That is fixed component of electricity charges. And there is another charge that is based on consumption. So if you consume more, you have to pay more bill. Consume less, you have to pay less bill. So once again, that is an example of semi-variable costs, wherein certain portion is fixed and certain portion is variable. So both of them put together, they will become semi-variable costs. But this is the fixed component and this is the variable component of the total semi-variable cost, we can say. That is about one type of cost, and depends, not that every cost we can exactly classify into completely variable, completely fixed. Every cost is not possible to be exactly classified. There may be certain types of costs which are neither completely fixed nor completely variable. They are partly fixed and partly variable. So we call them semi-variable cost. And there are another type of costs which can be called semi-fixed cost, or popularly called as step costs, a stair-step variable costs, or sometimes called semi-fixed cost also. Either way it can be called. Step cost is the popular word used for it. So what will be such type of costs, and why would they become like steps? They will be increasing definitely along with the output increasing. If you observe, they are also increasing, but they are not increasing like this. They are increasing stepwise. And why is that? Let us take an example, it is easy to understand. Say, if there is a school which wants to take its students to a picnic, and they wanted to hire a bus for it. Each bus has a capacity of, say, 50 students. Now, a bus has to be hired irrespective of whether there is 10 students or 30 students or 50 students, for sure, isn't it? So one bus will be required. Let us take this example only. Let us say one bus is enough if the level of activity is up to 50 students. One bus enough means whatever the bus charge will be, that will be fixed. So to that extent, it is fixed. But up to what? Up to only this level of activity, in this case number of students of 50. So if number of students are 50, one bus is enough. 30 also one bus is required, 10 also one bus is required, 2 also one bus is required if the tour is on. So up to 50, the cost of the bus or the charges that we should pay to the bus are fixed up to 50 students. Imagine now another 10 students are said we will also come to the picnic. So now the requirement has become a space for 60 students. You don't say that 10 students will stand and all. No, they will not stand. They have to sit. They're going for a long journey. So even for this additional 10 students also, one bus is not enough. You need 2 buses now. So what happened now? The cost has become double, increased, because you need 2 buses. Again, 70 students also, 2 buses is enough. 80 also, 90 also, up to 100, 2 buses are enough. Imagine 120 students are coming for the trip. Then 2 buses are not enough. You need 3 buses. So once again, cost has increased, but fixed once again till 150 students. Like this, these costs will increase stepwise. So they will be fixed up to certain level and then change. Again fixed, again change. Again fixed, again change. Again fixed, again change. Why is it look? How is it looking like that? That is why it is called as step cost. So it is looking like steps, stairs. So it is called a stair-step variable cost or semi-fixed cost also we can say. That is another kind of costs which remain fixed over a certain range of output. They remain fixed over a certain range of output. However, suddenly they jump to a new higher level when output goes beyond a certain limit. Output in the sense here, level of activity. For us, the level of activity in our example was number of students. So similarly, same example can be taken to a manufacturing organization. Let us say one foreman is required. Foreman is something like supervisor. Let us say one foreman can have a supervision of 2 machines only at a time. Let us say if you have one more machine, you cannot say the same foreman will look after the 3 machines also now. No, not possible. A sudden jump of another foreman also will have to be appointed, and that will be additional cost. And again it fixed at that, it will be fixed at that level till one more machine is installed. After that again another foreman will be required. Like that. Any examples can be taken. For example, you take a hospital. Hospital normally will have a policy. Let us say for every 5 patients, there should be 1 nurse and 1 compounder available. That is the policy of a hospital, let us say. So, if there are 5 patients, 1 nurse, 1 compounder is enough. But if there are 6 patients, 1 and 1 are not enough. You need 2 nurses and 2 compounders. Because that is a policy of that hospital. For every 5 patients, there should be definitely compulsorily 1 nurse and 1 compounder. So up to 6, 7, 8, 9, 10, this is okay. This is fixed. Once it becomes 12 patients or 11 patients, you need 1 more patient, 1 more nurse and 1 more compounder. Like this, step costs or stair-step costs will also be there in the organizations if the situations are like that. Don't say every time it will be like this. Certain costs behave like that. Certain costs behave like this. Certain costs will be pure fixed costs. Certain costs will be pure variable cost. So depending upon realities, we cannot just jump to conclusions. These are theories we are talking. These are possible concepts of different types of cost we are talking. But in reality, it would be not that easy to really classify everything into these 4 categories. They will fall somewhere in between them. But definitely we require to calculate and we require to classify them. Not here in reality. Here what we are supposed to know, the nature of them. How the completely fixed cost behave. How does the completely fixed cost behave? How does it behave? It will be remaining constant irrespective of the level of output. Total fixed cost remains constant. How does the completely variable cost behave? As the output increases, the total variable cost also increases. Both are directly related with each other and vice versa. How does semi-variable cost behave? First of all, it will have a fixed component which will not change. Over and above that, according to the level of activity increasing, the total semi-variable cost also increases. How will the step cost behave? It remains fixed up to certain level, and as and when that level changes, it goes up and again becomes fixed. Again it goes up and again it becomes fixed. So we call that step cost or a stair-step variable cost. Such kind of costs also will be there. That is the nature of different types of costs, we can say. Now look at the short run total cost curves. Total cost we are talking, not average, not marginal. They will come later. We are talking about total cost. Same thing we say there is a total fixed cost which is naturally constant, never changes. So there is a fixed cost always there, which will be not changing irrespective of the output, which is on x-axis. Costs are on the, let us call this level of activity on x-axis, costs on y-axis. And the cost remain fixed. If it remains fixed, that is what we call fixed cost. Total variable cost will be like this. Why are we curving sir here? Let it be there. Straight line will not be there. No, practically there will be some curve. How that curve will be? Will it be exactly like this? No, it is just a shape. Don't worry too much about the shape. Worry about the tendency of it. Where it started? It started from 0. That we have to identify. That is total variable cost. That is the total variable cost, which increases along with level of activity. But total cost starts from fixed cost, right? Because fixed cost is already there. So what will be the total cost? It will not start from 0. That starts from fixed cost. And it will also increase along with the level of activity or output increasing. So total cost and total variable cost and total fixed cost will look like this. In the short run, we can call these things as short run total cost curves. By looking at the nature of them, we should be able to identify which curve is that. Naturally, if it is parallel to the x-axis, that is a fixed cost. If it is going upwards from 0, whatever the shape it may be, it is a total variable cost. If it is starting from somewhere and then going upwards, that means it is total cost. So simply speaking, what is total cost? Total cost is nothing but total fixed cost plus total variable cost. That is total fixed cost plus total variable cost. That's what is total cost. That's it. And if that is drawn on the graph, the short run total cost curves will look like above in figure number 9. Okay. Now, as we already observed, how the total fixed cost curve is. Naturally, it is a horizontal straight line parallel to x-axis. That was the total fixed cost. Why is that? Because it remains constant for the whole range of output, naturally, right? And this curve starts from a point on y-axis, which means that the fixed cost will be incurred even though the output is 0. Even if the output is 0, there is some fixed cost definitely there. That is why it is parallel to x-axis. Only fixed cost, if you look at it, starts from here. So even if the output is 0, there is some fixed cost that is incurred. So that means it is starting from y-axis and parallel to x-axis. That is what we already observed in the graph. And same way, if you look at the total variable cost curve, that rises upward naturally. Why is that? Because as the output increases, the total variable cost also increases. Both are in direct relationship with each other. And once again, as we already observed, the total variable cost curve starts from the origin. Why is that? Because variable costs are 0 when there is no output or when the output is 0. That is where the total variable cost curve starts from origin. So when we look at this type of a curve, we have to understand we are talking about total variable cost starting from origin. Total fixed cost curve was parallel to x-axis. Of course, there is another point here. Variable cost increases at a decreasing rate, then after that increases at an increasing rate. All these things will come to them when we understand the theory of cost in line with the theory of production. The curvature of the total variable cost, we don't have to worry now. That will be there anyway. But how does it behave? It will increase at a decreasing rate initially. It will increase at a decreasing rate, and then it will further increase naturally, but increase at a increasing rate as there is an increase in output. So why is that? You can just understand this is the effect of the law of increasing and diminishing returns to the variable inputs. So now production theory and cost theories will be coming into the same line. What happens initially when the production keeps on increasing, when new and new variable inputs are inputted, what happens? Initially it will cause increasing rate of return, increasing returns it will give to the variable inputs. That was a short run production theory. When the variable inputs keep on increasing, initially they will give increasing returns. After that, they will give diminishing returns. Now understand the other side. When the production is giving increasing returns, cost will be not increasing fast. It will be increasing at a decreasing rate, which is a positive thing. So production is increasing, costs are also increasing, but not at an increasing rate, but at a decreasing rate. Whereas after some time, once stage 2 is entered, diminishing returns will start to the variable inputs. When the diminishing returns are starting, then also the cost will increase. Of course, we are talking all variable cost. Always they will increase when there is an increase in output. But now they will increase with the increasing rate. Why? Because of diminishing returns. So increasing returns will give a decreasing rate, and diminishing returns will give a increasing rate in the increase of output. Understand this very carefully. Link between cost and production will be naturally opposite. When it is good in production, that means more return. When it is good in costing, that means less cost. So when it is bad in production, that means less return. Same thing, bad in cost means more cost. So if costs are increasing at a decreasing rate, that is good news. If costs are increasing at an increasing rate, that is bad news. And what is the bad news there? That was diminishing returns. What was the good news earlier? That was increasing returns. Correspondingly, the costs also will change according to the same theory of production. That happens in case of total variable cost. So total variable cost, if you observe the curvature of this here, it has increased at an increasing rate. Later on, it starts increasing at a increasing rate. Initially, it will increase at a decreasing rate. Later, it will increase at an increasing rate. Because of that, the curvature has occurred. Otherwise, it would be straight line. If it is proportionate, it will be straight line, but it will not happen like that because of the law of variable proportions. That's what happens. Right? Then, what about the total cost curve? Which is nothing but adding the fixed cost and total variable cost curves. If you look at the total cost and total variable cost, the slopes are same. The slopes are same, and there is a distance between them that is indicating what is the magnitude of variable cost. So the distance between the total cost and the total variable cost, this is indicating the variable component of the total cost. The distance between x-axis and this is indicating the fixed component of the total cost, because total cost starts from here. So where it is starting? At fixed cost it is starting. Right? So that is what the total cost and total variable cost will be. And if you observe, even in the graph also, both are having same slope. So if the total cost curve is like this, total variable cost also will be like this only. Whatever the shape of this is, this will also be same. But what is the point here? Distance between these two indicates the variable component, and the distance between these two will indicate fixed component. That is about total cost curve. That's what is mentioned here. These are all questions which are important theoretically, because each of them is a conceptual point. So what does it say? The slopes of total cost and total variable cost are the same at every level of output and at each point. At each point, the two curves have a vertical distance equal to the total fixed cost. And its position reflects the amount of fixed cost, and its slope reflects the variable cost. That's what we are talking about. Position reflects the amount of fixed cost. Position means where is it starting? The total cost is starting where? Where is it starting? Is it starting here or here? That reflects the fixed cost component. Slope means like this. Is it like a little flatter? Is it like this or is it like this? If it is like this, that means the variable component is too much. If it is like this, the variable component is not that much. So the slope of the total cost curve reflects what? That reflects variable cost. And the position of the total cost curve reflects fixed cost. That is also two different points which can be asked as questions. Position means where it starts. Let us say it starts here, the total cost curve. If it is starting from here, this is telling about fixed cost. This is fixed cost. But how the slope is? Is the slope much slanter or is it much flatter? That also will have an impact. Is it like this means too much variable cost component is there. If it is a little bit like this means variable cost component is not that much. So that is the points also to be noted related to the fixed cost and variable cost and total cost. So once again, the summary of this is very important. The short run total cost curves behave like this. The total fixed cost line will be parallel to x-axis. Total variable cost curve will start from origin and goes upwards from left to right as the output increases. Total cost will start from total fixed cost, and from there onwards it will keep on increasing along with the level of output also increasing. And the total cost curve position reflects its fixed costs, and the total cost curve's slope reflects its variable costs. That's it. That is about short run total cost curves. What we talked about here is total cost curves. But that is not over. The real important actual crux of this entire theory of cost comes here. That is the short run average costs. So here we have to be very, very focusing about the average costs in the short run. How do they behave? We are not talking total, we are talking average costs. Just like average production, here also average costs can be calculated. Average concept is always the same. Average is nothing but total divided by quantity. So what is average fixed cost? Nothing but total fixed cost divided by total quantity. That's all. Total fixed cost divided by quantity. That is average fixed cost. What is Q? Number of units produced and sold. So what is average fixed cost is nothing but fixed cost per unit of output. For example, it's a very simple thing. Don't need examples for that also. But still, let us say a firm is having a total fixed cost of 2000 rupees. Output is 100 units. Average cost will be how much? 2000 divided by 100. Naturally, it will be 20. Now, this is important. Let us say the output increases to 200 units. See, originally the fixed cost was 2000. Output was 100 units. 2000 by 100. Average fixed cost was 20 rupees. That is 20 rupees per unit. That's what is average fixed cost. Now let us say the output has increased to 200 units. Will the fixed cost change? No, it will not change, because fixed cost itself means it will remain constant irrespective of the output. Fixed cost numerator TFC, total fixed cost is still the same 2000, but denominator is now how much? Instead of 100 it became 200. So 2000 by 200, how much is the now average fixed cost or fixed cost per unit? That is 10. That is 10. Why? 2000 divided by 200 units now. And as the level of activity increases, that means Q increases, always the denominator keeps on increasing, right? When we look at any graph, level of activity which is there on the x-axis, the output, as it is increasing, the denominator in this particular formula will keep on increasing and numerator will be constant. Numerator will not change. So the total fixed cost is a constant amount, it will not change. Output increases, that is denominator. When numerator is constant, denominator is keeping on increasing, what happens to the resultant? That is average fixed cost. Naturally, it will steadily fall. In this example, from 100 units, the output increased to 200 units. The average fixed cost has fallen from 20 rupees per unit to 10 rupees per unit. So average fixed cost will steadily fall always, because the output, the denominator keeps on increasing. So if we draw an average fixed cost curve, it will slope downwards throughout its length. But it cannot touch the x-axis naturally, because the average fixed cost cannot be zero. How can there be a zero average fixed cost? So it will not touch x-axis. That is another feature of it. Which one we are talking now? Average fixed cost curve. and average fixed cost calculation. Earlier what we talked about here, this graph is important for total cost curves. This what we are talking about now is average fixed cost curve. Average fixed cost is nothing but total fixed cost divided by number of units, which will keep on decreasing as and when the output is increasing. That is average fixed cost curve. Now comes the most important of this chapter, the graph which will give you most of the marks in this chapter. Like I told you about the law of variable proportions in the theory of production, the graph related to the output, which had total output or total quantity or total product, average product and marginal product. Same way for costs, it will be this graph which you have to practice, and you have to understand each of them one by one, what is happening to each of these costs. First look at average fixed cost. That's what we are looking at. Average fixed cost, what happened to that? Always it keeps on decreasing. It will be always sloping downwards. So that's what is there. Always the average fixed cost will be like this only. Why? As the output increases, since fixed cost is constant, total is constant, denominator is increasing, because of that average fixed cost will decrease. So that is negatively sloped always downwards from left to right, but it will never touch x-axis because it doesn't make sense to have any average fixed cost per unit to be zero. Zero is not possible. Some amount will be there, positive amount. So that is the average fixed cost. Now look at average variable cost. The next type of observation here, that is average variable cost. How to find it? Same thing. How to find average variable cost? Total variable cost divided by Q. Total variable cost divided by Q. Q is number of units produced. So what is average variable cost? Nothing but variable cost per unit of output. Logic is same. But what happens to the average variable cost and how it will behave? That is different from the average fixed cost, because average fixed cost has only one tendency. Always it falls. Always it will be sloping downwards from left to right. There is no change in the average fixed cost tendency at all. But average variable cost is not like that. Normally, the average variable cost falls as the output increases from 0 to normal capacity due to occurrence of increasing returns to variable factors. Once again, you have to remember the production theories. Without relating them, this will not be understandable. In the short run, in the law of variable proportions, initially what happens? Initially, there will be increasing returns. In the phase of increasing returns, what happens to the average variable cost? Increasing returns means average cost will normally fall as the output is increasing in that phase. So if you just observe for general understanding purposes, how was the product related curves? So those are all going upwards like this, no? Like this it was going, right? That will be opposite for cost. When the productivity is super, it is going well, cost will go down. Cost means not total cost, average cost will go down. So that's what happens. The direction exactly, if you observe, earlier was like this. Now the direction of cost curves will be like this, because these are opposite. When it is doing a fantastic job, the cost will become lower and lower. When it is not doing a good job, the cost will become higher and higher. So when the increasing returns to the variable factors was happening, what happened to the average variable cost? Look at that. At that stage, it has started declining. That is average variable cost. Average fixed cost is done. That will be always like this only. There is no problem in that. But average variable cost, what is happening to that? Initially it declines, then later it increases. Why is it declining? Why is it increasing? Because of production theories. What we know in the production theories, initially there will be increasing returns to scale. During that phase, the average variable cost decreased. Everything was working fantastic. Efficiency was good. But after the normal capacity output, the average variable cost will rise steeply. Why is that? Because the diminishing returns will start. in that phase, right? Then the average variable cost will keep on rising. So in case of diminishing returns, when we say production, it was going downwards. When production or product, average product is going downwards, average variable cost will go upwards. That's what happens here in case of average variable cost. So what is happening here, if you observe, initially they will go down, the average variable costs, and then later they will go up. So that is the application of production also theory in relation to the cost theory. Initially they are going down, the average variable costs, then they are going up. Why? Because this phase, it was increasing returns. That was the phase of increasing returns to variable factors. Once again, you have to be clear, we are talking short run, not scale. Variable factors, increasing returns to the variable factors was happening during this phase. Later on, what is happening? Diminishing returns was happening to the variable factors. So when diminishing return was happening, automatically the variable cost curve, the average variable cost curve goes upwards steeply, which means it is increasing. So cost increasing means bad. Output decreasing means bad. That we have to always keep in mind clearly. So bad phase is what? This. Of course, that is where they will operate. But that happens. Where to stop, here, that they will decide. But this is what happens in the phase of diminishing returns, which we already discussed. So what happens here in the case of average variable cost is, basically it will fall, then it will reach a minimum, and then it will rise. That's it. So average variable cost is here reaching at the minimum where it started rising afterwards. Okay, that is the average variable cost curve. So basically the average variable cost curve will first fall and then reach a minimum, and then it will rise. That's what we can observe in figure number 10 related to average variable cost. Now, the average total cost. Average total cost means what? That is nothing but the sum total of average variable cost and average fixed cost, which is nothing but AFC plus AVC. Average fixed cost plus average variable cost is equal to average total cost. So average total cost is nothing but cost per unit, in other words. That is the total cost divided by the number of units produced. In other words, total cost divided by Q. That is what is average total cost. And naturally, the behavior of the average total cost curve depends upon the behavior of the average variable cost curve also and fixed cost curve also. If you observe this average total cost curve, what happened here in case of average total cost curve is, initially the average total cost curve was going down, and after some time it started going up. Once again, why is it going down? Why is it going up? We have to observe. And where it started going up, that also we have to observe. But before that, let us quickly go through this explanation related to the average total cost. So the average total cost is what? Total cost divided by quantity, or average fixed cost plus average variable cost. Fine. So as long as both the average variable cost and average fixed cost both are falling, the average total cost also will fall sharply, because in the initial stages Average fixed cost is falling. Of course, average fixed cost keeps on falling, but average variable cost falls in the initial stages. Both are falling means they are having a huge impact on average total cost, and average total cost is also falling sharply, drastically. When average variable cost curve begins to rise, still average fixed cost will fall steeply. It will continue to fall because of average fixed cost. So on one hand, average variable cost curve started to rise, but even then, because of average fixed cost still going down, average total cost is also still continuing to go down. That is also happening even after the average variable cost started increasing. That you can observe, because average variable cost started increasing here itself, but average total cost started increasing here. Still, the average total cost was further falling only after the variable cost. The average variable cost started increasing also. Why is that? Because of average fixed cost, which is falling always. That has a more result on the average total cost, and that will further go down even though the average variable cost started going up. Why is this happening? Again, if you understand, here this is happening because the fall in the average fixed cost is greater than the rise in the average variable cost. AFC is falling, AVC is rising, ATC is falling. But why is it happening? Since AFC is falling more than AVC is increasing, so the impact on ATC is downwards, so it is also falling. So as the output increases further, this tendency will not continue. Then there will be a sharp rise in the AVC, which will offset the fall in AFC, that is average fixed cost, which means the sharp rise in AVC is more than the fall in AFC. Then naturally ATC also starts increasing later. So what happens to the ATC, that is average total cost? First falls, reaches to the minimum, and then rises. That is the reason the average total cost is a U-shaped curve. And if you once again remember the production, that was bell-shaped. This is U-shaped, opposite of that. Average total cost is U-shaped curve. So once again, to understand what is happening in each cases, AFC is always falling, no doubt in that. AVC falls in the initial stages due to increasing returns to variable proportions, variable factors, and afterwards AVC increases due to diminishing returns to variable factors. Whereas average total cost initially declines because of cumulative effect of reduction in AFC also and reduction in AVC also. However, even though AVC starts rising, ATC will continue to fall in the next stage, where what was happening? The reduction in AFC was much more than the rise in AVC. But that will also not continue further. After some time, AVC will rise so sharply that it will nullify the reduction in AFC, and it will be impacting the average total cost upwards. So the average total cost will go up. So average total cost will first go down, reaches its minimum, and then goes up, thus forming a bell formation, a U-shaped curve. Bell is the opposite of this. This is U-shaped curve, that is average total cost. Now if we introduce marginal cost to this, we have one more aspect. Marginal, we know the concept of it. What is marginal? Marginal is always 1 plus. That is, what is the addition that is made to the total cost by production of an additional unit of output. If you produce one more unit of output, how much total cost will be increased by? That is called as marginal cost. Same thing. Let us say if you take the total cost of producing T units and T minus 1 units, the difference between these two is called as marginal cost. Again, if you take an example, say 5 units are produced at a cost of 200 rupees, and now the 6th unit is produced and the total cost has become 250 rupees. From 200 it has become 250 rupees. What is the marginal cost of 6th unit? That is 250 minus 200. How much additional cost is resulted due to addition of one more unit of production? That is 50 rupees. 250 minus 200. That is marginal cost. What if, let us say, instead of one unit, we are given that 10 units are produced at a total cost of 320. 5 units costed 200. That was the original cost. 5 units costed 200. Now, instead of 6, 7, 8, 9 and all, directly we are taking 10. 10 units costed 320. Now, if you want to find out marginal cost, how to find out? That is a point. Simple. The formula is difference in cost divided by difference in output or difference in level of activity. So, what is the difference in cost? 320 minus 200, that is 120, divided by difference in level of activity, 10 minus 5, that is 5. So what is the marginal cost in that case if we take is 24 rupees. That's what is mentioned here. In case instead of one unit, if it is given as a jump, all that we need to do to find out marginal cost is difference in cost divided by difference in output. That's what is mentioned here also as a formula. Symbolically, marginal cost can be found out like this, which is nothing but total cost. Delta total cost means difference or change in the total cost divided by change in the quantity of output. That is what is marginal cost. Right? That is a point to be noted here. And when there is a change in output, will there be change in fixed cost? Definitely not. So that is why marginal cost is independent of fixed cost. So what it will be impacted by? It will be impacted by only variable cost. Why is that? Because the total cost will not change because of fixed cost. It will change because of variable cost when there is an increase in output or decrease in output. So fixed cost will not change with the output. What change will be? Only variable cost. So the impact of variable cost will be more on the marginal cost, and the impact of fixed cost will not be there on the marginal cost because marginal cost is independent of fixed cost. Right? So that is a point to be noted. Why that happens? Also because of the nature of variable cost, which will change with the changes in the level of output in the short run. So simply speaking, the marginal cost is due to the changes in variable cost only. The marginal cost will be changing. It is only due to the changes in variable cost but not fixed cost. Why? Because this delta TC, whatever you take, the total change in the total cost is not happening because of any change in fixed cost. Fixed cost is same. So change in total cost is happening because of change in variable cost. So that will only have an impact on marginal cost but not the fixed cost. That is also another point to be noted. And the formula for marginal cost can be change in total cost divided by change in output. Or it can be even noted as marginal cost is nothing but the total cost of manufacturing n units minus the total cost of manufacturing n minus 1 units. That will give the marginal cost of nth unit. That will give the marginal cost of not n units, nth unit. Total cost of n units minus total cost of n minus 1 units will give the marginal cost of nth unit. That is the nature of marginal cost. The concept of marginal we know already. Now let us apply that to this graph. All of them are plotted in the same graph. Marginal cost. What is happening? Same story. It will first go down. Further, it will go downwards initially, but later it will start increasing steeply, and it will cut the average total cost line from the below. It will cut the average total cost line from the below, and if you observe from the graph, where is it cutting the average total cost line? It is the point where the average total cost is minimum. Average total cost is minimum at that point, Afterwards, the average total cost started rising. Till that point, average total cost was falling. But when the marginal cost line cuts the average total cost line, average total cost starts rising. That we can observe from the graph. And basically the marginal cost is going down initially and later it is increasing. And where the marginal cost line is cutting the average variable cost line, once again it is cutting where the average variable cost is the lowest. So these are the various aspects of marginal cost line. Now let us understand them, how it behaves. Of course it falls initially as the output increases. Yes. After a certain level of output it starts rising. That is the same thing. Why is that? Reason is similar, because of the law of variable proportions. And the marginal cost curve becomes minimum corresponding to the point of inflection on the total cost curve. Which means what? Wherever the minimum of the average total cost curve is there, that is where the point of inflection, as we see earlier, where the marginal product started coming down. Here the marginal cost will start going up. That is the point of inflection we can call. It is the same thing but the opposite side, that's all. So what happens in the marginal cost? When the marginal product rises first, reaches the maximum and then declines. That we know. That was marginal product, right? Rises first, reaches maximum, then declines. Exactly the opposite happens to marginal cost. That ensures that marginal cost of a firm declines first, reaches minimum and then rises. So exactly it is corresponding to the marginal product line or marginal product curve. Marginal product curve was bell-shaped. Marginal cost curve is U-shaped. As usual, it is the opposite of the product. So that is marginal cost and average total cost and average variable cost and average fixed cost curves all in one. So what you should be doing? Naturally, you should practice this one many number of times. This graph, that is figure number 10, you have to practice many number of times according to the relationship existing between those things. You have to be able to draw them. But if you observe that data related to marginal cost, average total cost, average variable cost and average fixed cost, we can take this table also for observation and understanding purposes. First of all, the total fixed cost is same in all the cases, irrespective of the number of units of output. The total fixed cost has not changed. That is always the same. That is 1000 rupees. That is total fixed cost. But average fixed cost, what happens? Which is nothing but total fixed cost divided by number of units of output. So what is the average fixed cost? 1000 by 0. You cannot have anything like that. So that is nothing. Then 1 by 1, if you take 1000 by 1, 1000 by 2, 1000 by 3, like that, the average fixed cost will keep on falling. It will never be 0, but it will keep on falling only, as we observed in the graph. Average fixed cost is always downwards only. It will never rise. It will be always falling only. That is average fixed cost curve. That is what is depicted in the data also, in the schedule also. Now coming to the total variable cost, naturally total variable cost will be directly related to the output. As the output is increasing, the total variable cost always increases. This is total. Now, what about average variable cost? Average variable cost is different. Average variable cost, if you observe, average variable cost is first of all what? Total variable cost divided by number of units. 0 by 0, nothing, so you cannot have it. Then 50 by 1, 50 rupees. Then you have 90 by 2, 45 rupees. Then you have 140 by 3, 46.67. Already it started rising. So from 50 to 45, it just reduced a little bit. But after a little bit of reduction, it started rising. That is average variable cost. From there onwards, if you observe, it kept on rising only. 49, 51, 54, 57, 60, 63. Like that, it keeps on increasing after reaching its minimum at 45. That is average variable cost. Now look at total cost. Total cost means what? Nothing but the total of fixed cost plus variable cost. Add these two things, you will get total cost. So naturally, it starts from fixed cost, which is 1000, then 1000 plus 50, 1050, like that. Let us say for 7 units, what will be total cost? 1000 plus 400, that is 1400. So total cost is nothing but the total fixed cost plus total variable cost. But now what is marginal cost? Marginal cost is what? That is the addition in the total cost due to one additional unit. So marginal cost of 0 unit anyway will not be there. For first unit, how much was the marginal cost? From 1000 it has become total cost of 1050. Difference between these two is the marginal cost, which is 50. Then difference between these two is 40, like that. 1090 to 1140 means once again 50. So here also, if you observe, the marginal cost has first decreased from 50 to 40. There onwards it started increasing and kept on increasing tremendously. 50, 56, 59, like that. But how did we get this marginal cost? Total cost of n units minus total cost of n minus 1 units. In the exam questions, if it is given like what is the marginal cost of 10th unit, you should say 1670 minus 1570, which is 100. That is the marginal cost of 10th unit, like that. Any marginal cost of any units you should be able to calculate, that is marginal cost. Then we have average total cost, that is different, which is nothing but the total cost divided by number of units. Once again, for 0 there cannot be anything, but first unit onwards, the total cost 1050, that means average total cost is also 1050. Further reduced, further reduced, further reduced, reduced, again, it reduced till down. Then it started increasing. So once it starts increasing, it actually becomes irrelevant. Why? Because nobody will reach to that stage, or nobody will operate at that stage. There's no point in continuing the production of 13th unit. Already when 11th to 12th unit itself, the average total cost is high. There's no point in producing 13th unit at all. So it will stop there, normally, practically speaking. But how the average total cost is behaving? It is decreasing. Definitely it is decreasing. Why is it decreasing? It is decreasing because of two things. One, because of a decrease in the average fixed cost. That is one thing. And to some extent, because of a decrease for some time in the average variable cost. But afterwards, even though the average variable cost was increasing, but the average fixed cost was decreasing more than that. So it started, let us say, decreasing further. Now just look at numbers, that will be clear. Look at any particular number. Let us say 5 units of output is the level we are looking at. What was the average fixed cost? 200 rupees. Average variable cost is only 51 rupees. So average fixed cost earlier was 250. Now it has come down to 200. Whereas average variable cost is increasing only from 49 to 51. There is a decrease in average fixed cost of 50. Increase in average variable cost of only 2. So which is powerful here? Average fixed cost is powerful. So what happened? The average total cost further decreased. So that's what happened here. Wherever the average fixed cost is there, and in all the cases if you observe, that is more than the average variable cost till now, till here almost. So till here average total cost was declining only. Why? Because average fixed cost is more and average variable cost is less. In all the cases, that's what happened. That is why the impact of average fixed cost is more on the average total cost than the impact of average variable cost. But now look at the 12th unit, what has changed. 12th unit, the average fixed cost has become less. Average variable cost has become more. Now the variable cost started working ugly. So it will have a negative impact on the average total cost. Negative for cost means rise. So what happened? The average total cost started rising from there onwards. That is how the total fixed cost, total variable cost, total cost, average fixed cost, average variable cost, average total cost, and marginal cost. If you observe and understand this table, that will be beneficial in understanding the graphs also. But of course, that table and graphs do not match exactly with the numbers. The graphs are more about tendencies, what happens and what is the relationship, how the graphs have to be interpreted, that is different. But this is telling the facts of the nature of the total fixed cost, variable cost and total cost, how the average fixed cost will be behaving, how the average variable cost will behave. It will give a broader outlook only here, overview only here. But whereas the graphs will tell us the tendency of each of them in detail. So this is about the short run cost theories. But now look at the other points also to be noted here. First point, the fixed costs do not change with increase in output up to a given level. We know that. That is why the average fixed cost always comes down with every increase in output. We know that. Just summary. Second, variable cost increases, but not necessarily in the same proportion as the increase in output. Variable cost and output are directly related, that is sure, but are they proportionately related? Not necessarily. So in this above case, the average variable cost comes down gradually till 4 units are produced. Average variable cost, not 4 units, actually 2 units. This is wrong. Till 2 units are produced, the average variable cost comes down in this table. Earlier it was average variable cost 50, 2 units average was 45. Then it started increasing. Then afterwards, for producing 3 units and onwards, the average variable cost will keep on increasing. Then marginal cost. We know this already. What is that? The additional cost divided by the additional number of units produced. This also comes down first and then starts increasing. We can observe from the table. Marginal cost originally starting with first unit it was 50, second unit it was 40, reduced. Then started increasing. It again became 50, then again increased it to 56, 59, etc. It kept on increasing drastically, and by the time it reached 12 units, too much. It was 300 rupees marginal cost. Tremendous amount of marginal cost was there afterwards. So this also first falls down and then increases. Actually observing average variable cost also, average total cost also, marginal cost also will have the same tendency, but the phases will be different. All of them will fall down first, then increase. But which one will first increase? Which one will increase later? That is where we have to be observing. For that again you have to refer to the production theories. Which one will first decrease there? Marginal or average? Marginal. Same happens here also. Which one will first start increasing in this? Marginal will first start increasing. So it is started increasing at this point only, earlier. Then average variable cost starts increasing at this point. Average total cost starts increasing at this point. So first marginal cost will rise, then average variable cost will rise, then average total cost will happen to be rising at a later stage. Exactly once again the opposite of production theory. No difference there also. But that was opposite side. That was decline which was recorded there. Here it is increase which is recorded there. Decline in production is a negative thing. Increase in cost is also a negative thing. So initially there will be positive things. Afterwards there will be negative things. That is common. That is about the short run cost curves, we can say. But once again, if you look at the relationship between the average cost and marginal cost, similar relationship will be there like any other marginal or average quantities. What are the relationships between these two? Let us understand. Between average cost and marginal cost. When the average cost falls as a result of increase in output, naturally we are looking at only one increase in output always, but the average cost is falling. So when the average cost is falling, the marginal cost is less than average cost. Same like production. There, if you remember, the marginal product was more than average product. When the average product was rising, here exact opposite. When the average cost is falling, the marginal cost is less than the average cost. So look at the situation here, just like for example taking the same graph. So what was the average cost? The average cost was this, or average total cost is what we are talking about. When average total cost was there, when the average cost was falling, marginal cost was less than the average cost. Marginal cost was less than the average cost till this point. where it has cut the average cost, where the average cost was minimum. But before that point, average cost was falling and marginal cost was less than average cost. So when the average cost falls, then what can we say? The marginal cost is less than average cost, that is below the average cost. When the average cost rises next level, then the marginal cost is more than average cost, because marginal cost has already crossed the average cost curve. So where the opposite happens, let us say the average cost is increasing, then marginal cost will be more than average cost, and where these two things will become equal, where the average cost is minimum. Where the average cost is minimum, at that point, the bottom of the U, we can say, that is where the marginal cost is equal to average cost. When the average cost is minimum, that is the lowest, the bottom, we can say. There earlier we had the peak of the product. Now naturally the cost will be opposite, the bottom. So or we can call this floor. When the average cost reaches the floor, the lowest point, at that place the marginal cost is equal to average cost, and the marginal cost curve cuts the average cost curve at its minimum point. That too, it cuts it from the below. That's what is there here also in the graph. If you observe what is happening here in the graph, the average total cost was there, which was there like this. Marginal cost is there like this. And what is happening, as long as the average total cost was falling this period up to here, the marginal cost is below the average total cost. Once the average total cost started rising, then the marginal cost became above the average total cost, and the marginal cost is cutting the average total cost at its minimum point. That's what is the relationship between marginal cost and average cost. When we say average cost here, what are we talking about? We are talking about average total cost. That is the relationship. And exactly it is the opposite of the relationship between marginal product and average product. There it was the opposite, if you remember. There the marginal product was above the average product as long as the average product was increasing, and it was equal with the average product where the average product was at its peak, and the marginal product was below the average product when the average product was falling. That was opposite shape. It was all like this shape. Now the shape is different. It is this shape. So here, when the average cost is falling, the marginal cost is less than average cost. When the average cost is rising, then marginal cost is more than average cost. When the average cost is at its minimum, that is the place where the average cost and marginal cost will become equal. In other words, the marginal cost curve cuts the average total cost curve from the below. It is cutting the average cost curve from the below, naturally. From the below it is cutting. And once again, if you just remember the other earlier product curves, where the marginal cost was cutting the average cost from the above. It was cutting from the above because the shape was opposite. Here it was marginal product cutting the average product from the above. Marginal cost cutting the average cost from the below. So relationship is there, definitely the logic is same, why it happens is same, reasons are same, production and cost both are related. The only point here is we need to observe the tendencies of this average cost, which is average total cost, and marginal cost. What is their relationship? Other things like average variable cost and average fixed cost, anyway we know. Average fixed cost is always going downwards, and average variable cost initially goes down and later it will increase. And Marginal cost also initially goes down and later it increases. Average total cost also it will go down initially and later it increases. But the relationship between the marginal cost and average cost is one of the important aspects to be noted when we look at the marginal cost curve and average total cost curve. Of course, marginal cost, average variable cost also more or less the similar relationship you can observe. There also the marginal cost is below the average variable cost initially. Later it has cut the average variable cost curve and then raised. And the point at which the marginal cost has cut the average variable cost also almost is the lowest point of average variable cost. So when we say average cost here, we can interpret for average variable cost also and average total cost also. But if nothing is mentioned, it is total cost. That is the point to be noted. But the tendencies are same. There is no difference at all. Marginal cost going down below the average cost, whether it is total or variable. It is cutting the average cost, whether it is total or variable. And then it is going above the average cost, whether it is total or variable. But if you want to relate it to the production theory, then variable cost average you have to keep it aside. Average fixed cost, average variable cost do not have any direct relationship. Here, what you have to relate is marginal cost and average total cost. Those two can be definitely related. And we are not having total cost here. There in the production graph, we had total product also. So here we have four things which are looked at. Out of them, marginal cost and average total cost can be directly related with the production theory also, but in the opposite direction. Average fixed cost always goes down. Average variable cost goes down first and then it increases. That's what is the short run cost theory. We can say the short run cost curves, and different types of costs will behave like this in the short run. Why this happens? Because of the law of variable proportion. Simple. Initially there will be increasing returns, after there will be diminishing returns, after there will be negative returns. So when the negative returns will start here, that is the place where the marginal cost cuts the average total cost. So once the marginal cost has crossed the average total cost also, marginal cost is there and average cost is there. Marginal cost is cutting the average total cost here. This phase we should not even think about, because marginal cost is more than average cost and average total cost is rising. Average total cost rising is absolute wrong. That is phase 3. That should not happen and that will not be happening also in the organizations. But initially, when the average cost decreases, why it is decreasing? Average variable cost particularly, which has more impact on the average total cost, after the average total cost has reached its minimum. Before the average total cost has reached its minimum, average fixed cost has more impact on average total cost. So, why this is increasing later and decreasing first? The reason is same. That is the law of variable proportions or diminishing returns. Different phases. The phase of increasing returns will decrease the costs. The phase of diminishing returns will increase the costs. And the phase of negative returns will increase the average total cost also, which will be absolutely pathetic to have if it is happening. It should not happen. That is about the short run cost theory, we can say. And in the next sessions, we'll discuss about the long run cost behavior, how it will be. But prior to that, core aspect of this chapter is definitely the short run. Even in the production theory also, even in the cost theory also, the two graphs are going to give you many marks than anything else. So you need to practice this particular graph also, that is contained in figure number 10. This graph everybody should be practicing a number of times. Of course, it may not exactly cut at the place and all, that's okay. But as long as we understand it is happening, what is the tendency, what is the relationship, that's enough. But you practice more, you definitely will be able to get it correct. Number of times you draw it, that will help you in solving the questions more than remembering, more than by hearting, more than just mugging up. One graph will give you so many marks. So why to lose that opportunity? Practice that graph. That will tell us many things, that will answer many questions in a very simple manner. So that let us take a easy route rather than by hearting and unnecessarily trying to mug the things up. Not necessary. Everything is visible in the graph. If you can have the graph, you don't have to remember anything. You just have to see the graph and identify what is the relationship. That's all. But yes, understanding is required, because why is it happening also we should know. Reason is already known to us, that is the production theories which we already discussed. And in the next session, we'll continue with the long run cost function. And with that, we can conclude this chapter 3, unit 2. Till then, take care. Bye bye. Thank you very much.